The bigger news for the day, possibly the biggest news for the day as of at least till now, is the announcement of the merger of Tech Mahindra and Mahindra Satyam. Ratio of 2:17. Neither here nor there. Maybe the shareholders of Mahindra Satyam would have been happier looking at what it has in terms of assets as well if it was close to 1:8. But I'm no expert. The one who is joins us right now on the show, Bhaven Shah, CEO of Equirus Securities, to talk about not just this, but the larger IT pack at large. Bhaven, good to have you. Thanks so much for taking the time out. Just a prima facie word, Bhaven, on what do you make of the merger ratio per se? The merger was anyways expected, but 2:17, a bit neither here nor there, and more to probably a little more tilted towards Tech Mahindra, you would guess?
Yes, I think if you look at various measures, Satyam is still work in progress. So if the merger were to happen a year later, perhaps the ratio would be a little bit more in favor of Satyam. So in that respect, yes, this ratio is somewhat tilted in favor of Tech Mahindra shareholders. That's what one could say, because Satyam is earning a higher ROE versus Tech Mahindra, and the price to book multiple for the combined entity at the suggested merger ratio is similar to the existing price to book multiple of both companies. However, given that Satyam with a lot of overhang still remaining with respect to some of the legal uncertainties and so on, shares are somewhat depressed compared to their potential value. So in that respect, a merger today is slightly more in favor of Tech Mahindra shareholders.
Even operationally, given that Tech Mahindra's dependence has been on British Telecom as a key client, you think this merger would help de-risking the business model of Tech Mahindra?
Yes, indeed, it will definitely. I think Satyam has a much broader service offering and client base, and so this will definitely help with that de-risking for Tech Mahindra.
What else are you seeing in terms of how the combine can be, just these two brands coming together, how that can be leveraged to kind of pitch for new clients or expand business and also gain market share for the conglomerate?
So both, I think the Satyam takeover was done quite some time back, by Mahindra Group. So they have had some time to, work with clients and so on to sort of, in that respect, even though Satyam is a much broader known entity among the client base, Tech Mahindra was is not a known entity among the client base. Perhaps the time they already had, they would have done a reasonable job of communicating that it belongs to the same group, and that should allow them to market under Tech Mahindra brand as a one company, and there should be some potential synergies from SG&A. We'll have to hear from the management on that front, but that could be some synergies that also could benefit the combined entity. We'll have to wait to hear from them.
So, Bhaven, how do you, as an investor, approach Tech Mahindra now? I mean, sure enough, there are arguments that it becomes $1 billion entity or over $1 billion. Dependence on BT goes down. Dependence on certain business segments goes down, like telecom, for example. But does all of this make it a compelling reason to buy into Tech Mahindra? Or there are better plays available, even in the large cap IT space, that would probably compel you more, as opposed to Tech Mahindra post, of course, the merger taking shape?
We don't have an official rating on Tech Mahindra, so but I think what I can tell you is that we don't have any compelling reason to buy the stock. I mean, we feel that where we have active coverage, we do see opportunities in companies like Hexaware, for example, or for that matter, eClerx are the two names that we currently see decent upside. Whereas on the large cap IT, we are somewhat cautious.
Okay, so we'll talk about the caution first, Bhaven, then get on to the couple of ideas that you did mention. TCS, there was a sort of a warning that was, kind of given, wherein Q4 might be a bit of a suspect out there. Does that give you reason enough to worry for the entire large cap IT space, or would this be restricted to TCS one? And two, there has been a bit of a correction that has happened in TCS post that coming out. I mean, hardly any, 5-6% after the run-up on the last 2 days. But large cap IT as a whole, I mean, 3 or 4 stocks out there. What do you do with them? Avoid them at the current levels?
Yeah, we don't see upside. We see downside over the next 6 to 9 months on the large cap IT. So that includes basically the entire group by and large. We see it that way because we feel that we are in a structurally new environment whereby the volume growth that these companies can achieve is going to be significantly lower than what investors have been used to. And the share price valuations already factor in pretty healthy growth rates. So we don't feel that any of these stocks have a meaningful upside. I mean, we have been sort of on a relative basis suggesting HCL Tech because they are more aggressive, more looking at more willing to go for growth. But I think overall we feel cautious about the large cap IT because we feel that 15% growth is something that is more likely to be the new normal, even and maybe towards the upper end of the new normal. And in fact, as far as the TCS warning is concerned, I'm a little surprised by the market reaction, I think, because TCS had talked about slow March quarter even 2-3 months back. So I don't think it's a new warning. It's just that a little bit of a sort of enthusiasm in the market, and some of the stocks rallied, and then now there's a bit of a pullback. But March quarter was expected to be soft for all these companies, and that is exactly our point, that in spite of healthy corporate profits for a couple of years now, we are not seeing IT spending growing at a historical pace rate. So there is a sort of deflating of these IT spending with respect to corporate profit that is happening, and furthermore, there is a reduction in that offshore multiplier, the rate at which offshore volume growth comes through versus the IT spending growth. So structural shift in the industry that I think market is still trying to understand.
All right. Getting down to your specific recommendations or your specific ideas from the sector, Bhavin, what is it that you would like right now in the mid-tier IT space especially?
So we don't cover a whole lot, so our recommendation is limited to a couple of names at this point. We continue to like Hexaware. The stock has done very well, and that's where some investors are jittery that after such a nice run-up last year, is it sort of too late? However, what we see is that the company has transformed itself from being a very much a niche player in one segment to a more of a broad-based service provider. They've done an excellent job of lowering their costs, and also both at the SG&A level as well as at the operating level by widening the hiring at the lower end, at the entry level. And I think and with all that, they can we expect them to continue to deliver close to 20% growth. And one important thing we like about them is, and this is something that we have we feel lacking from the large cap IT, is the dividend payout. Hexaware is paying pretty healthy dividends. 50% payout ratio is something that gives a very nice dividend yield on a company that can still grow maybe close to 20%. So that's why we like Hexaware, even though we understand it has done really well over last year.